Chapter 4, Part 2, Accounting Changes, Discontinued Operations, and Other Comprehensive Income. Now, accounting changes. Accounting changes fall into three categories. We have changes in accounting principles. That's like when you go from LIFO to FIFO. Changes in estimate, that would be like if you decide your allowance for a doubtful account should be 5% instead of 4%. And change in reporting entity, you go from owning less than 20% of another company's stock to owning more than 20% or more, and then you have to account for it differently. And the other thing, and it's not a change, is when you have a correction of an error, i.e. you're doing something that's non-GAAP, or you made a mistake in prior years. So an example of a non-GAAP item is going from cash accounting to accrual accounting. Now, change in accounting principle. It refers to a change from one acceptable accounting method to another. Mandated changes in accounting principles, implementation approaches. Now, you're going to go back if you can. If you can only do somewhat, you do a modified retrospective approach, which means you go back, or you would just do it prospectively if you cannot go back. Voluntary changes in accounting. Accounted for retrospectively by revising prior year financial statements. That would again be a change in inventory costing going from, let's see, what be LIFO to FIFO, be an example. Now, change in depreciation, amortization, or depletion method. These are considered a change in accounting principle, but we treat them as a change in accounting estimate. They are accounted for prospectively, accounted for the same way as a change in accounting estimate. One difference is that most changes in estimate don't require a company to justify the change, which you would have to do if you change your depreciation, amortization, or depletion method. This change in estimate is a result of a change in accounting principle and therefore requires justification. Next, we have a change in accounting estimate. Change is due to modifications of an estimate as new information comes to light. Example is, or adjust your warranty reserve would be another one, which is also an estimate. Or another would be you change the how long you're going to keep a piece of equipment. These are accounted for prospectively. If the effect of the change is material, a disclosure note is needed to describe the change and its effects on both the income and earnings per share. Prior period adjustments, these are usually errors required when a material error is discovered in the statement that have been published and distributed to shareholders. Requires that the company record a journal entry that adjusts any balance sheet accounts to their appropriate levels, accounts for income effects of the error by increase, or they're treated as an adjustment to beginning retained earnings. And you need to have a disclosure note. Discontinued operations. If a company decides to sell or dispose of a component of their business, profits from these discontinued operations will not continue. Normally, here's how it works. The minute you decide, you have to separate out their revenue and expenses, the whole division, and you have to do it as of the beginning of the year. Okay. A component of an entity or group of components has been sold or disposed of, or considered held for sale. Disposal represents a strategic shift that has or will have a major effect on a company's operations and financial results. Income or loss from discontinued operations is reported separately below income from continuing operations and is always shown net of tax. So now let's walk through an example. Okay, Mike's company had income before tax of $1 million in 2021 before considering the following material items. Mike's company sold one of its operation divisions, which qualifies under GAAP as a separate component, which means you could treat it as a discontinued operation. The before-tax loss on disposal was $340,000, and the division generated before-tax income of $500,000. The company also incurred an $80,000 restructuring cost, and you assume the tax rate is 25%. Okay, before considering additional items, we have to adjust for the restructuring costs, because that would be income from continuing operations, and then we would take away our tax, and that would give us income from continuing operations net of tax. Then we would show our discontinued operations net of tax, and I show you how I do my calculations there off on the right. And now we have net income if we don't have any other comprehensive income items. Now we're going to look at comprehensive income. Comprehensive income. Transactions with owners include issuing stock to shareholders or decreasing equity by purchasing stock from shareholders and paying dividends. All other changes in equity during the period arise from non-owner sources and represent comprehensive income. So here's how you get it. Net income plus other comprehensive income equals comprehensive income. The items. Okay, there are a few gains or losses that are not reported in the income statement. These other gains and losses are reported as part of other comprehensive income. Net unrealized holding gains and losses on available for sale investments. It's not short term, just available for sale. Gains or losses from post-retirement benefit plans. Deferred gains from derivatives and foreign currency translation adjustments. Now let's look at an example. Now, we have net income from operations before tax of $6,860,000. The tax rate's 25%, and we've had the following material non-recurring transactions. First, one of the factories was closed and restructuring costs were $1.2 million. Now, you would think those would be part of other, but they're not. They changed it, so this would be treated pre-tax and as part of operating income. They disposed of an operations division that qualified under GAAP as a component that incurred losses of $560,000, and assets were sold with a gain of $1.4 million. This would be part of discontinued operations and show net of tax. Investments were sold at a loss of $220,000. In addition, there was unrealized gain of $320,000 on available for sale securities. The loss on sale would be part of other, shown pre-tax, and the unrealized gains would be part of other comprehensive income, shown net of tax. It was discovered that depreciation the previous year was understated by $200,000. This would be an adjustment to beginning retained earnings and treated as a prior period adjustment. Our last transaction is we had negative foreign currency translation adjustment of $240,000. This would be part of other comprehensive income and would have to be shown net of tax. So now we'll walk through what that would look like on the income statement. We start with income from operations. We adjust for those restructuring costs to get operating income. We then adjust for the loss on sale of investments, and now we have net income from continuing operations. We adjust for our taxes, and then we do our discontinued operations, but remember, these are always net of tax. Then we do our other comprehensive income, net of tax. We have unrealized gain, net of tax. Foreign currency translation, net of tax, and the net results of those is we add that into net income. So total comprehensive income is $4,770,000. And this ends part 2.